All right. Peace and blessings, everybody. Welcome to Sauce Factory Wednesdays. Okay, another glorious Wednesday, another glorious day in the market. Now, today we're going to be going over market structure shift and change of characters, right? Well, if we're going to revisit liquidity sweeps and liquidity runs inside of the same topic, that way we can improve your trading with a little a slight tweak. These little details, a lot of things be going over people's head on a regular basis, but we're going to cover that today on the Sauce Factory. Okay, listen, let's lock in. All right, so first thing up, we got crude oil on the 4 hour, right? The CL1, you already know what time it is. It's a continuation chart. So when you're looking at it, the market is currently inside of a downtrend. Just reading simple market structure, right? Just by looking at it, you start from this high, boom, we can run a trend line, right, and easily determine, hey, this in a downtrend. Now, reading a chart like this, you come up to a market chart and you say, like, what's going to happen next? Right. And if you looking to trade this, you're going to say, well, I need a down swing, but when I'm going to get that? We're on a 4 hour chart. I know a lot of people scalp this, even if you swing trade this. You can swing trade this in USO, but it's more than one way to doing it, right? Whatever way you choose to. This is the one thing that threw a lot of traders off. It's this pop right here. Okay. Everybody seen it. It happened last Friday. Boom, pop, and went off. Went clean up. Right. If you're still trying to shark the market, you would have been wiped clean. It would have wiped your nose here. And you wouldn't understand why. But let me tell you why. Two simple things happened. You had a breaker structure from here to here. Right. Let's type that up. This. Boom. So once you had that breaker structure, that's also because because I found it. Boom. That was your liquidity sweep right there. Market swept liquidity, which was here. So people stop losses was sitting here. That way they can go long here. Forgot you gotta let this thing go. It ain't gonna just give you from point A to point B. Reason being is because they was targeting here. Okay. So understanding why, look at the last time it came here, right? Boom, SOS. They're gonna keep doing the same thing. Market always repeats itself, right? It's the same thing. It got here before. This is the last time because price reacted, right? That's simple. Price went down, bounce, went up. Price went down, taking out the low, right? Yes, typing it in, right? So once they took the low, breaker structure, that means they put in a new high at the price start coming down. Great. Takes the low. Boom. But instead of it keep running, all it did was wick, boom, boom, and run up. Now you got to ask yourself, why did this happen? We got to get into the psychology of the trade. The psychology was we had breakout traders here. That's why it's a BOS, breaker structure, right? What happens when you're a breakout trader? So you want to go short here. What you going to do? You're going to say, well, stop loss last, I want to go to the previous candle high and I want to run down to another low, I'm going to run lower, right? You'll look to the left, 9-10. You'll look to the left, say, hey, I got an opportunity here, right? We got a boom. We got a little structure there. I want to target this back-to-back fair value gaps, right? So I know price coming there. So I want to target that, right? Even if I want to say, hey, I'm going to take the low. Go to this point. Oh, man, that's great. 160 something ticks. You'll probably go down to a lower time frame, find something that's gonna actually hit your target, and you're gonna want to play that, right? That's what they thinking because price has been coming down. And guess what? You say it's a downtrend. I'm good. I have nothing to worry about. So you'll cut on a moving average, right? This is my 34 simple moving. You say, well, we below the 34. That's bearish. I'm good to go, right? They say, well, if that one didn't work, cut on the other moving averages, right? So this is my 513, 200. But we can cut off the other ones. We're just going to keep on the 200. We below the 200 on a 4-hour chart. That's a bearish market. I'm safe to take it down. Well, in your head, you say they're going to go there as soon as they break out because I missed this move down. So I'm going to wait for the pullback like a responsible trader should. And then as soon as it breaks out, take the low. In continuation, I'm going to take the trade. Well, that ain't how the world works. You cry in the car because that's what they did. They took your money. You had your order sitting there, ready to go short right here. Great. Well, guess what also was sitting there, right? It's people who went long here. They said, hey, this is a good reversal spot. Why? Let's put a line here. Oh, look, price came here before and bounced, right? So this is support. It been here multiple times, right? So we can keep doing this all day long and finding support here. Well, so this is a support area. Cool. Price got here and bounced before. Did you look at it? It formed a nice little block. So that's what we're looking for. So we're going to go long here when it get down to this area. We just going to have to catch it, right? So that's what these traders was looking for. So what did they do? They simply say, hey, we're going to go long. They had their order like that. Stop loss below here because that's below support. So, yeah, that's the lowest point. Let's see. Boom. So, yeah, your stop loss going to be right below support. That's what they're going to do. Right? 9 and 10, they stop losses just like that. Order somewhere in here. Boom. They ready to go long. So you had trades looking like this. And 9 and 10, they was targeting some high, which was here, or the last swing high. But they're going to want something greedy, right? Most traders are greedy. How would you come back to this trade? Let's start from this swing point and run a fill. We're going to run a field to whatever low. We're going to say, hey, this is low as the market taking place. Remember, this is a 4-hour chart, so we got number time. If they expect the market to come down anywhere in this ballpark, I can actually plot my field right here without price even getting here yet, right? And then from there, I'm going to say, hey, I'm going to target 50% or at least a 61% retracement. But I'm not a greedy trader, so I'm going to look for a 50% retracement on this said bounce before they drive price back down. By the time you get to the 61, I want to be out the market, looking to go back down with the market, right? But at least give me a 50% retracement. That makes sense. So from there, these traders was long here, or they could have been modest and say, hey, we're going to look for a 38% retracement. Who knows, right? But this is what they did. So the moment they went short, some people left their orders because they greedy. They got runners. Everybody always talk about leaving runners, right? You know it. Everybody said, they say, hey, you get a trade, leave some runners in the market. That way it can maximize the full potential. You want your 1 to 3 trade, then you want your 1 to 10. So that way you can make as much money as possible. Okay. How you do that? Multiple contracts scale out at different price points. Once you get your 1 to 3, take some off table. Then you let the other one run to a 1 to 10. If not, leave the stop loss where it's at. The first trade paid for the second trade, and you call it even, right? Who cares? You're still going to make progress. You lose one, you still have a 1 to 2 to fall back on, right? So they'll leave a stop loss there. That'll go on. But what happens, price does this. Let's get that out the way. I'm going to zoom in. Oh, let me cut this moving average off too, because y'all got that point. Boom. Price start coming. Let's get rid of this film, right? Well, let's talk about it real quick. So once we say, hey, price actually did this, you would actually redraw your field, drag it down. Now, on the nose, Price touched at the 38% retracement. Consolidated, then drop. Now, this is where things get interesting, right? So let's get rid of the fib. Let's get rid of this. Y'all got to understand that point, right? Boom. Y'all understand that. Let's get rid of all of this. Let's clean this chart back up, right? Y'all got that. Boom. Yeah, got that. Let's clean this thing back up. So once they did that bounce, made a 38% retracement into this fair value gap here. Right. Once they came back into that fair value gap, we can drastically drag that out because this is actually very relevant later on. So what did they do? They dropped down. They didn't quite displace price back to the downside, but they rebalanced price here. So now you have a rebalance zone here that they focus on, right? Okay, great. But this is what the market shift come in. See that? Boom. When it came back up, this a failure swing. It did not make a new high. It did not go back to return the highs. So when that said trip happens, now it's getting very dicey to actually take the upswing. That's a failure swing back high. So instead of it saying, hey, this is the low, higher high, higher low, it failed. It could not do it. Failure swing, boom, boom. Price did that, right? So for illustration purpose, price should have done this. Boom. Took the highs, kept running. But price did not do that. Price fell. So only what happened was price said this, boom. This is my high, boom, and start falling. Right? It failed to make new highs. From there, you seen price consolidate. Now it's building market structure to the downside. Boom, boom, lower low, lower high, boom, lower low. You thinking to yourself like, hey, they just swept these guys. This is my opportunity to run lows because we're going to go lower. Well, this is where the market makers really take your money. As you sitting here for the breakout saying, hey, we're going to go low. This line now. They took these guys out who had their runners that did not exit trade, who fall asleep at the wheel, which I always say, do not fall asleep at the wheel while trading, right? It's very important that you stay awake and understand how to track your trade. Don't get too greedy. Put your stops, loss, and profit, because in no way you should let the market take all this back. You should have had a stop loss somewhere in profit. I don't even care if you got a runner or two. Put it somewhere in profit, at least cover itself, right? That way, if it do come all the way back, you're covered because they're going to come back for that. They stopped those guys out. Now you looking to say, hey, look at this strong candle. I'm going to take it down. I'm going to get this money on the breakout because we got another fair value gap down here or the block, whatever you want to say. We got this OB right here. We're going to target that. That's my goal. Look at all that down pressure. You got 1, 2, a candle like this. No way they're going to push again. No. Complete 180, flip it. Now they running. Where? Take the highs, right? They fooled you. They got you, coach. They got them. Now, what happened was this was called a liquidity sweep. They knew the sellers was going to be there. They knew the buyers was there, right? They knew boys was going to look to short the market. They knew boys stop loss was going to be there. All they did a breaker structure, complete 180, flip the market to do what? Run highs, right? You see the little break. Now, this is where market liquidity sits at. Remember, if I'm going to go short, where my stop loss going to be at? At structure. It's not going to be over there. It's going to be somewhere up in here, right? I'm trying to have my stop loss somewhere in this range if I'm on any of these candles, right? If I was going short here, or let's say I was on any of these candles trying to go short here, my stop loss is going to be there in this ballpark, right? I'm not trying to have a big stop loss. I'm not trying to have my stop loss anywhere. It's gonna be there. Because two ways you could have went short. You could have went short at the break of this wick here. Stop loss right there. That's your entry. Boom. And you want to run it down. Great. Right? Or you can say, hey, I see market breaking down. Boom, boom, boom. I'm a savvy trader. I'm up here because I see consolidation. It made a 38. It made a failure swing, right? From there here to here. We had this little failure. It failed to make a new high. Price consolidated, arched over. So all I'm going to do is wait for another low. You could even had it here. You're actually an aggressive trader. You could have had it there, stop loss at the highest candle, which was this one, right? This your highest candle. Your stop loss could have set right there, low risk, boom, high reward. Because if anything, you're smart. If you're taking this trade, you're going to target this low here all day. This your target, right? Boom, boom. Now, that's what I like to do. I want to get out right before this low, right at the low, right above the low. I like getting out right there all day long, right? Put my little TP right there. Boom. This is my target all day long because I know they're going to come sweep this low. I don't want to sit around and see what happens. If you're a sensible trader, you would have been out the market here. You're a greedy trader, you'd have been looking for this. They would have, boy, they would have snatched a wig off. It's that wig snatching right here. When they do this, snatching wigs. All right, snatch them and run. Whoop, swept. Got swept. That quick. Boom, gone. Out of there. That's when the reversal come in. Most people don't use stop losses. That's when they blow their accounts. This candle right here, this is taking your whole account right there. You should know the downtrend is over for the moment. They're going to run up. Okay. Where did they go? First level, market liquidity. That's simple. Boom. Right? They took liquidity. Okay, great. Now, where did they go after that? Let's clean this up a little bit. Let's slide over now, right? When they came up, slight pullback. Pay attention to the pullbacks because this is it. Let's pull back, push up, got that. Pull back, push up, got the rest of the liquidity, right? Definitely took it out there. That's when they started doing what? Dropping down. Pop, but then it starts shifting. Now the market is shifting. Now remember, this is your external structure now, right? This is your new low. So this is the external break of structure. This was a low, so this is the break. What did they do again? Sweep. SOS, but this time they ran a way higher because they knew that's what time they was on, right? So these are details you must pay attention to that a lot of traders miss. Yes, squeeze the bottoms. These are details that a lot of traders miss that cause them a lot of pain because you're still trying to go short when the market's ready to reverse and go long. There's a lot of details here, right? So we'll say, why did you stop there? What you trying to build? See this nice little consolidation point? Okay, of course you're going to stop there, right? The same zone, been a target. They finally breaking down. So are they going to actually drive down lower or are they going to want to consolidate and go up from here, right? But these are slight details you could have caught anytime throughout the day to say, hey, I'm going to go ahead and switch directions. I'm going to go along here. I'm not going to be still stuck in my mindset to say I'm going to stay short. That's the thing. Some people get overcommitted to the trade in one direction when you have to be flexible. Once they start taking out market structure on higher time frames, look for retracements. Once you start getting market breaks on 30-minute, 1 hour, 4 hour daily time frames, look for market retracements. The market must retrace. It can't go in one direction forever. Okay. So you always want to keep your eye on that. That can be the difference between you winning a day and you losing a day. because it's gonna go down. But by the time that happens, every little pullback or bear candle that you see, you think the market gonna drop. That's a reversal candle, but it's not. It still have a destination to get to. And unfortunately, you on the wrong side of that. Or by the time you finally get right, now it's ready to start back heading down in your direction. Now you playing both sides of the market getting chopped up, which is very unfortunate. So that's on CL. Let's get over. Do. I seen a nice little play on Apple too, right? Sticking to the 4 hour chart. So we see Apple being a nice little uptrend. Breaking structure. All right, we want to connect these lows real quick. Boop, boop. All right, cool. So from there, once it gapped up, this was your high, right? You had this gap here. Great. Now you look, say, hey, where did Apple go? I'm gonna grab a horizontal. All right, that was the last high that they took, right? Then from there, they took this high. This is on where price got here before, consolidated and dropped. What do we have here? We have a small little order block right here. Boom. Remember, I told y'all about these 3 candlestick order blocks, right? I know. Blow up game, right? Blow it up. Boom, boom, boom. So right there, we have a small little order block sitting right there. You see the rejection points. Zoom out. Price came back up into the zone. You had a nice volume imbalance right there too as well, right? So let's go for that. So you had volume imbalance plus order block, right? So zoom back over. So price got there, strong resistance, right? But this is the part where we got to pay attention to what happened with Apple. Look at that shift. You see how they just kind of beating price down? All right. Okay, cool. You're not paying attention to that. You're gonna think like, all right, we still bullish. Yes, Apple's in a definite uptrend, but for the moment, you gotta realize they pull back. Took out some structure here, right? Watch what they did. They took that out. Oh. What's that? So we're gonna do this. So once they took this level out, right? What did Apple do? Make their retracement back up, right? Sweet. I need to have that broom on standby. They see they can let me just go ahead and just They need to have this broom like on my little toolbox so I can get it faster. This is lit. Got a little sweep there. Then price retrace. Right. Went more than 100%. If you run a fib, you that's actually say, hey, I'm running a fib because it's in a downtrend for the moment. You just want to see what happened. Did 100% retracement, not price consolidating underneath 100%. I know sometimes those fields may seem a little different to see, but look, came right back up to the 100%, not coming down. Now, the purpose of these other fibs to let you know, like, hey, which level is resistance, right? After they reject, now it's holding that resistance at the 88%, 78%. It closed below that. It's heading back down now. Double top, boom. How we know it's double top? Because of the V, right? So let's clean this up real quick. I want to keep this chart clean. Resistance. Okay. Boom. Now this when you got to throw your chart patterns in here. Price shoot down rapidly. Price come back up. Now price fail to come back up to break out. So what is the option here, right? That's what we're thinking about. That's what you set up for, right? If you reject there, then what possibly can happen? It's not a double top yet until it breaks out. It got to break out 186.60 for it to be a double top, but price is rejecting from a high potential double top pattern. Well, we're gonna wait and see. But these are situations you pay attention to. If it failed to do this, well, I'm gonna wait and see what happens over here using your market structure shift, liquidity sweeps, and is reading your chart. Look and say, hey, why is rejecting here? This is resistance. This is a zone. Let me pay attention. Where is going to come back down? Is it going to come back down? Well, now, if it is going to come back down, where can it possibly come down to? Let me run a fib real quick. Boom. Okay, great. It came down this time. It bounced 61%, right? Now it's came back up to the 23, but now it's hovering around a 50% retracement mark. What's the deal here? Right? No matter which way you flip this fib, it's resisting and holding that support in this ballpark. Somewhere over here, we have a problem, right? We have a problem over here. So these are details you pay attention to. You don't want to overdo it. Don't want to overthink it. Just keep it smooth, right? But these are details. Pay attention to those. So that's Apple. I want to switch over to one more stock. And then I'm gonna open up for some questions. Which one was it? MR. MR. MAMRA. Yeah. All right, cool. So right here, they had a nice little rally, right? But remember, like I told you, they took highs, boom, 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 boom. Do do do. Yo, what's that? They took that high real quick. Okay, great. But now look what's happening, right? They shifting back down. We thought they was gonna have a nice liquidity run. Probably try to come for this high here. Because as you see, they currently in a downtrend. If you look at it, from this high to this low, they going down. That's what happened back over here. Right. So far, they only in the 38% retracement. We already know what time it is. They did this little fancy little up move like this. Yay. Right. Oh, we did that. Uh, took that high out. Get my thing over there. Took the high, took the liquidity, then dumped. Boop, boop. And this is what I'm talking about here. See, the moment they dump, this was your market structure shift. MSS. MSS Missouri. All right. So once they did the breaker structure here, bang, this was a little small internal part, right? And then they went to the external for the liquidity sweep. Most traders say, oh man, that's it right here. Then boom, they're gonna push up a little bit higher, get one more, right? So they'll say, oh yeah, this is bullish. It's going up. It took the high. So you'll count that bullish, but in reality, they finesse you, shift, and then they start changing direction. How you know? Guess what? This should pull back. Boom. Then what market do? Boom, 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 boom. Everything but go up. It did everything but go up. Okay. So these are details you're looking for, even if it's doing all of that. Pay attention. When it start pulling back, you say, okay, cool. Price is consolidating at a high. Price pulling back. Look for your external levels. Mark those out. If it breaks that, well, guess what? That means the market should change. It ran its cycle. It did all that fancy stuff. These the people holding the bag, right? Because always somebody left holding the bag. Because these people say, hey, we good. They didn't pay attention to this internal breaker structure. They didn't pay attention to that. They fell asleep at the wheel. Okay. They fell asleep at the wheel, did not pay attention to it. actually happens there because they should have never took out this candle, right? They did it. Boom. We over. Boom, boom. Kept breaking down. Boom, boom. Kept on shifting. This is how you know it's really real, right? This is a wide level here. This was a pivot point that they took. Boom. BOS. That's me. Okay. They took that out. They kept on rocking. Remember, like I told you, when they take out a higher time frame, it's an external structure level. What they start doing, retracing, right? So after they took that out, now they starting a little uptrend, right? Currently, this is what it's doing. Yeah, it'll be all right. But they trying to shift. They're trying to change the narrative, right? They're trying to change the narrative to pick it back up to make a retracement. But we see what time it is. So this one to kind of get into your fundamentals. This when you start looking at long term, start seeing what they got going on. Look like they passed their earnings. Okay, cool, but still dropped off because they pretty bearish, right? But these the details. Paying attention to market shifts, breaker structures, liquidity sweeps, putting all those combinations together, right? My broom again. Get my broom. Whoop. Mm-hmm. Market sweeps. Then uh both yeah. Uh-huh. Yeah, it's out. Yeah. Got to get the parachute because they did the sweep in two different locations. Boom. Liquidity sweeps. You already know what time it is. Get the parachute out. We're going for a ride. Okay. Liquidity sweep. Boom. The boys racing back up. SOS. They do it in all markets. I'm telling you, every single market, they do the same thing. Breaker structure, change of character, market shift, liquidity sweep. Once they get an external breaker structure, guess what? They're going to sweep some liquidity, run the opposite way so they get people more interested in that side for the fake out. Then they continue on about their direction. So that's that. Now, do we have any questions? Feel free. Yeah, a couple minutes.
Hey Neil,
Yes, sir.
hey, got a question. Like, if you could, could you just trade just strictly off of the external liquidity sweeps, and then just wait till it get to a certain point on your field, and then just take it down, and then I guess just not pay attention to the internal
Yes. Yes, you can. It's the internal typically happens when you're trying to
day
scalp and
trade.
day trade. Yes.
Gotcha.
But when you're actually looking for the large swing trades, or not even a small swing trade, a day trade worth your time, because a lot of times we are taking these day trades and they only moving 1, 2, 3 points at best, right? And then we fighting because we don't get the best entry, you don't make that much money. But you actually go through the market, whatever ticker you are currently trading, because I know you got a basket of tickers, right?
Right.
And if you actually mark levels up like this, look, you can set an alert. Say, hey, I'm gonna set an alert real quick. Boom. All right. Let me see. Look out. Look. That's it, right? Then boom, you create the alert. Now, once price cross that line, you know to go look. That makes sense. Even if you don't want to
Yeah.
draw it like that. So you see my templates on Sunday where I got, hey, little templates like this, real quick, boom. So this sell side liquidity, I can add an
Right.
alert to this. Boom. Just like that, create the alert. As soon as price cross that line, I know what to do. I know to go look at that chart. Until you get those type of alerts go off, don't trade. And by doing it on a small basket of stocks that you know very well, say, I got XYZ amount of time. Let me at least play it back up to the 38 or the 23 to 38% retracement once it shows me it's ready to shift and go back up, right? Once I have my confluence. But yes, you can do that. A lot of traders do. They don't want to trade every day, it's too distracting. And like I told you, it's very tasking on the mind and body to sit and trade the market every single day because you're not going to be successful all the time. You're going to have a day where you off. You may have a whole entire week that you're off because you're forcing trades, you're forcing setups. And by doing that, it plays with your confidence, it plays with your mindset, and it weakens you. So when it's time for you to actually take that trade you're supposed to take, you don't have the confidence to hit the button when you need to hit the button.
Right.
Because
Yep.
most people ain't gonna want to go long here, right? They're gonna say, man, this thing going down, the first red candle, like here, you gonna enter a put and it's gonna keep going up on you. You feel me?
Yeah, that makes sense. Gotcha.
All right. No problem. Anybody else? Stop recording real quick.